Welcome to the Leaders in Housing Counseling call. We have a pretty good and packed agenda today, and I wanted to get us started right away. So we're going to dive in, um, and please feel free to, when you have questions, to do them into the question box so that we'll be able to go through and get responses when we need it. So let's, and what we're going to do is we'll do our usual NHRC legislative updates by Melody, and then and then we'll also talk about the Sarah Jarek appreciation letter just a little bit, but acknowledge the importance of it. We'll spend a few minutes on the NHRC policy updates, a bunch of things that are going on in the mill, and just wanted to bring people up to date a little bit on the pluses and minuses of our work, and then so we'll touch on the housing counseling data fields and language preference on the IRLA, the 2019 HUD housing counseling funding, and the qualified mortgage issues, the QM, and the patch, and then but we'll really spend most of the call on RESPA and the big changes that are happening that will make it much easier for lenders to fund housing counseling agencies on a fee-for-service basis, and it really sets the rules of the road. It's very helpful, big breakthrough, and a lot of people have worked on this, and we seeing some real progress here. So this will be largely what the call will be about. We'll also touch base on NHRC members and the pictures. A picture's worth 1,000 words, our usual thing we want to make a plug on. Our next call in September will be on the student loans and the public service loan forgiveness program. Probably some of you have seen in the media that there's been there was last year a 97% rejection rate, and somehow, despite a congressional fix, it's a 99% rejection rate. We're going to bring in our student loan experts, Natalia Abrams and Cody Hunanian, and really the question is sort of what should we tell people, what should we tell our clients, what should we tell our staff, what can they do to make sure that they will be able to take advantage of this, and they're deep into this, so hopefully that'll be helpful. And I'm sure, as always, there'll be some advocacy handles to that as well. So that'll be in 2 weeks. Good. So let's dive in. So, Melody, a lot of congressional work here. Tell us what's happening.
Hi, everyone, and welcome back to the call after a very long August recess. While Congress was in recess, we were definitely busy. We were working really closely with House and particularly Senate offices, educating them on housing counseling issues and also discussing fiscal year 2020 appropriations, which is where we'll jump in. In terms of the Senate Transportation HUD appropriations markup, what we're hearing is that that's scheduled for the week of September 19th. Right now, the subcommittee is very hush-hush about what particular allocations for each program will be. Those allocations are called 302Bs. We anticipate that's going to be a much lower figure than the House T-HUD level, which was at $60 million for housing counseling assistance. We've heard that it may be $50 million, which is pretty disappointing. But we're hoping that we can try and find a champion to sort of argue the point of trying to preserve either current levels or matching the House number. We had really great conversations with both Democrat and Republican offices. There's so many off the top of my head. Senator McSally from Arizona, Senator Scott from South Carolina. We have a call upcoming with Senator Portman. And so we're just really trying to maintain the drumbeat on the importance of housing counseling, as well as other housing counseling legislation, which I'll go into. Be on the lookout from me on emails. We would like to have more advocacy calls and have people really hear from their state groups or state agencies on the importance of housing counseling, not just around appropriations, but just as a resource. It's really important that in order for senators to see the value of housing counseling assistance and why it needs additional funding, they really need to know how it looks on the ground in their communities. So just keep an eye out for that. We're definitely going to send a lot of correspondence around that shortly. In the meantime, uh, Congress as well as the White House made it very clear to do not want a shutdown. I don't think anyone wants a shutdown again. So Congress is likely going to pass a stopgap continuing resolution to allow the government to remain open while they continue the process for completing appropriations for fiscal year 2020. And I'll send information on that as it comes through. In the meantime, another thing we were working on this August recess is educating Congress on the Community Development Block Grant Disaster Recovery legislation, as well as the Housing Financial Literacy Act. We've worked really closely with both Senate Banking and House Financial Services, as well as the sponsors of the legislation for the disaster recovery. So in the Senate side, it's Senator Schatz from Hawaii and Senator Young from Indiana. We've had calls with both offices, and they're very particular on the language of the bill, which we're happy with, but admittedly, we're disappointed there wasn't housing counseling language in the bill. Bruce and I had a really good, productive call with Dan Cheever, who is the legislative director over at Senator Young's office, and we sent him over the legislation language we would like to see in the bill. Our understanding is while Senator Schatz wants it to be a bipartisan bill, if the Republicans offer changes to language, we have a stronger chance of including it in the bill. So we're hoping that we can encourage different Republican offices to really encourage housing counseling language. It's a really critical part of the disaster recovery, and currently housing counseling is a qualified addition to plans for disaster recovery assistance, but it's not mandatory. So it just makes the process more difficult for housing counselors to be part of that recovery for communities. In terms of the Housing Financial Literacy Act, we're still trying to look for a Republican co-sponsor. The current sponsor is Senator Peters from Michigan, and they seem very excited about the bill. And we just got a very favorable CBO score for the House version. So I think that's going to help us encourage more offices to become sponsors.
CBO means what, and why is it valuable?
Forgive me, acronyms. CBO scores the Congressional Budget Office scoring the bill so they can understand the cost of any changes to a program. And essentially what we got back from CBO is that there would be no additional cost, which is great for us as advocates and talking to congressional offices. We had a really good call with Senator Scott's office. And Bruce, if you want to jump in briefly on the summary of that call. But ultimately, they seem pretty responsive, and they're very interested in having conversations on potentially being co-sponsors.
And just to remind everybody, this is the quarter-point discount on the mortgage insurance premium on FHA loans if you are counseled and educated by a HUD-approved housing counseling agency. And we were also able in the House, and this traveled to the Senate, able to get that it would be only effective before somebody had signed a sales agreement or provided a mortgage application, so that we're getting the people early in the system, we're rewarding them for coming to counseling, and we hopefully will have a more effective process than the last time there was a discount. But this is getting bipartisan support, and we're very encouraged by how far it's gone so far.
Yes, but we don't have any information on any timeline on markup. So we still have a lot of time to sort of talk to offices, educate the staff people about the merits of both legislation, and use that as an opportunity and a springboard to just talk about the merit of housing counseling overall. As I was saying earlier with Senator Young, for instance, while he is a Republican member of the Senate, he is one of the foremost champions on affordable housing right now. And he's just been a great resource. So there's always opportunities to sort of change minds and make people champions if we can make the case. So again, just be on the lookout for me on emails and advocacy calls and just opportunities to reach out.
Okay, thank you, Melody. And certainly people should, if you have any opportunity to talk to especially senators right now, now's the time to talk about the HUD housing counseling funding level. We believe we're $50 million in the Senate. It hasn't been public yet, but that's what we've been told. And any dollar we can get that to be raised, even a couple $1 million, will mean that when the budget negotiations happen, we're in a stronger position. The main groups have done a special outreach again to Senator Collins in Maine, and any opportunity you've got to express your the importance of getting a stronger number on housing counseling is huge. So with that note, I think everybody knows at this point that Sarah Jarek is leaving HUD on October 4th, and she'll have a limited schedule between now and then. And we are just, she's been a terrific, important, and I don't use this word lightly, transformative person in our work, and has been deeply helpful in many, many parts of our work, the most recent of which is this unraveling the very frustrating problems we had with RESPA, and which limited lenders' willingness to pay fee-for-service payments for our work, providing housing counseling services. But she's been kind of a visionary. She's thought big. She's been helpful. She's also been very accessible, has participated a great deal in these calls, in many forums, has visited your offices, did site reviews with some of your agencies, and all of you know how kind of when you talk to her, there's deep knowledge, there's a willingness to share, there's a deep interest in us being successful, but also, willing to be critical about what we are and where we need to strengthen our work. She's just been terrific, and so I think we had a whole discussion. We quickly had a group of 20 some odd people who were trying to figure out what the most appropriate thing to do is. And step one is we decided that we'd like to do just an appreciation letter. So that's circulated on the list, and so you can have a chance to read it. If it's something you'd like to participate in, there's links there, and you can go ahead and sign it. We would like to get this out. We set a deadline of next Thursday, the 19th. You always have to do some list cleaning and stuff like that, but my goal is that the following week, as early as possible, we might be able to get it to her. So we're not trying to do it the last day. I don't really know what her schedule is, and it was hard to tell, but the idea is that we get it to her early enough that she can appreciate it. And we, a lot of people have thought a lot about this, and I think this is a step one. I think we're also interested in maybe doing something after she's left staff, and we'll let you know as that progresses. But actually, just go back for a second on the other slides, Melody. I'm sorry about that. So the first picture you see on the upper left-hand corner, that's Sarah at one of the early Leaders in Housing Counseling meetings. And then right below it is the meeting with Brian Montgomery. She's almost all the way to the right, next to Ruth Roman. And then on the larger photograph is the White House meeting, which we really worked hard to get, and she really made it into a much, I think, more kind of generous and thoughtful session that really exhibited what housing counseling can do, and it was deeply meaningful, I think, for the people that participated, and people were quite thrilled with it. But it also, I think, kind of captured the breadth and range of the counseling work that we do. So now, if you want to click over to the next ones, there's just a couple more pictures of her in action, and we really appreciate it. So anyways, I posted the letter again. I'll put it up one more time, probably on Monday, and just so everybody gets a chance to see it. We've got well over 100 people have already signed, and I'm sure that we'll see a great deal more. But a small way of saying thank you for all the terrific and valuable work she has done. So with that quick note, let's run into just a few quick updates. So in August, when we haven't had a call since then, the FHFA made a decision around the language preference and housing counseling data fields on the Uniform Residential Loan application. And they had been in under the previous FHFA administration. There was a full review being done, and they took it out. So this was just disappointing and kind of a setback for our work. We really wanted these things to be hardwired into the mortgage origination process. Their explanation was that they wanted the ERLA to be a shorter, leaner document, and they only wanted the most essential things. We thought these were essential things, but the ultimate decision was that they were not going to. However, what they will do is they will continue having these data fields as a separate form called a consumer data form, and it's up to the lender to decide whether they use that at origination to collect the information. So this is kind of a work in progress. It's not ideal, but it's also not a zero here. We will try to pay a lot of attention into the design of this and try to make sure that that to the extent possible that when you're capturing information in this, it also gets hardwired in the same way that ERLA information does in the system. It's not an easy, it's not clear that will happen, and that's part of what we'll try to do so that it could be used more routinely and then we'll encourage lenders to participate, and you can have a role in that as well. I just put out this morning, we sent a letter, a little nudge to HUD. The board had talked about this, and I've heard from a number of organizations with just really big concerns about cash flow and how badly delayed the HUD housing counseling funding is again. Our guess is that the scoring should have been completed by now, and they should be at a point where senior management is reviewing it. So the idea was, let's get a letter in now that encourages senior leadership at HUD to get that money out as quickly as possible. And hopefully that'll be a marker that will help to move things forward. I appreciate lots of people have already responded just on that little letter. We didn't need 1,000 signatures. The idea was more to get the idea queued up, and that's why we went quickly with a handful of the NHRC board members. But there'll be other opportunities to weigh in on these kinds of things. And then finally, you may have been following this in the industry press, but and we posted on this, qualified mortgage is that part of Dodd-Frank that defines what a safer, less risky mortgage is. And one of the provisions that they had in there was that there be no more than a 43% back-end ratio, total debt ratio, in order to qualify as a qualified mortgage. And they made exceptions for Fannie Mae and Freddie Mac, and the rule actually doesn't apply to the HUD and VA and USDA loans. But on Fannie and Freddie, it was a sizable amount of their business. I think 14 or 16%, I'm not remembering exactly what the percentage was, were people who had a higher back-end ratio. And we joined in a coalition with lots of trade groups and some lenders and some advocates to sign on to a letter basically saying that we're comfortable with not having the 43% back-end ratio. I think from our perspective, my view is that what you really want to do is have people have good counseling, but also underwriting, and underwriters should be able to figure out. And I think what we have seen in our business for years is that some people can handle a 44, 45% or higher back-end ratio, and some people can't handle 43. And it has to do with how stretched out you are in your income, how you handle your credit, how you pay your bills, what your material needs are, and those kinds of things. And we think that counselors and certainly underwriters should be able to make that assessment and have compensating factors and other things to make that done. So the idea is that the patch that you do away with the idea that 43% is some bright red line in there. There's a lot more that needs to be done on this, and there was, and I'm sure there'll be more comments on it, but want to sort of keep you informed on kind of thinking on some of the issues. There'll be a lot happening on GSE reform. We don't know that it'll happen legislatively as much, even though there's a lot of talk of that. But there does look like there's a lot of movement on the administrative side, and we'll try to get housing counseling and some of the kind of underwriting things built into that as well. Okay, so let me stop there, and let's go on to the topic at hand, which is the RESPA provision. And this has been a topic of our calls in the past, and you've probably seen emails from us on this. Many people have worked on this, including people on the call, Lot Diaz and Gene Spencer and Matt Reby. The big problem has been that when RESPA regulation moved from HUD to the CFPB, the kind of regulatory regime that we were all using didn't travel with it, and CFPB said they needed to set their own standard up. It was never very clear what that standard was, to the extent that lenders felt some lenders continued to do fee-for-service payments to housing counseling for housing counseling services delivered, and some didn't. They said the regulatory risk was too high because they didn't understand what the bright red line was about when you might be in violation. We had meetings with CFPB to try to sort this out. They provided some guidance, and it wasn't as crisp as I think the lenders wanted. So it's been an ongoing issue, and HUD and CFPB work together, and this is really one of Sarah Jarik's last big efforts here to help sort this out. And so we've got an expert panel to talk about what's been done and how we think it'll affect our work and how you need to think about it as your agency. So we're going to start with Mark McCardle, so he's an old friend and from the CFPB, to explain what the CFPB has done. So Mark.
Thank you, Bruce.
Hey Bruce. Hey, Mark, hang on 1 second. This is Gene. Hey, look, before you start, unfortunately, I have a hard stop in about 15 minutes, so I'm going to have to jump off. But Mark is the expert in this arena anyway, so I was just sort of a participant in the proceedings earlier this week. So if I have to, I apologize for that. I misunderstood the timing a bit, but again, Mark's the expert, so I'm going to defer to him anyway. Hey, Mark.
You owe me a beer, Gene.
No, I will do that. All right.
Okay, take that one offline.
Okay.
Okay, thanks, Gene. So, Mark, why don't you get going, and if we'll check in if Gene is still there when you finish up.
Okay, and you can tell me to stop or let Gene, whatever you want to do. So this one of the great pleasures of this is I got to work with Sarah one more time before she retired. So retires. So that was great. You gave a good summary of the issue. This has been an issue since I joined the Bureau in mid-2017. We had a meeting earlier in 2017 before I got there with folks to try to provide some guidance, but the PHH case was ongoing, and the clarity, as you said, of the guidance wasn't enough for lenders who particularly were concerned about Section 8C2, about whether the mortgage lender may condition its payment for the housing counseling services on the consumer making contact or closing a loan. And when we started talking about this, HUD, when Brian Montgomery and Sarah were very active, saying this is one of their chief concerns, and they preferred a rulemaking, sort of a notice and comment rulemaking on RESPA, but we do not have that on our plate right now, and for those of us who know the Bureau, it takes a while to do a rulemaking. So that would have been years away. Fortunately, we were revising our no action letter policies. We have created a new Office of Innovation within the Bureau, headed by Paul Watkins, and that created another vehicle to address this kind of uncertainty. It's supposed to sort of clear up gray areas in the law by providing sort of comfort to folks in the marketplace and clarify areas where there are gray areas. So on last Tuesday, Gene was there. The Bureau announced the new no action letter policy, which basically strengthened some of the protections. The last one was more of the old no action letter policy was more advisory. This is binding on the Bureau. We also released a compliance assistance sandbox policy and a trial disclosure policy. And our first no action letter was awarded to HUD on behalf of all HUD approved housing counselors to provide clarity around RESPA. I will refer basically to that letter heavily today. You can find it at the press release. It's on our Bureau's press room website. It's called CFPB Issues Policies to Facilitate Compliance and Promote Innovation. And there's a link to the policy there. It's not a long application. It's about 12 pages. And basically, I won't go through it, but I will just focus on the key parts. Section 1 talks about the identity, which is HUD and housing counselors. 2 talks about the services you all provide. 3 talks about why counseling is a good thing. Section 4 talks about the potential risks, which RESPA is in place to sort of protect against. And in theory, without guardrails in place, funding relationships between mortgage lenders and housing counselors, where mortgage lender payments are conditioned on a contact or closing a loan, could be a steering risk in theory. And that's the kind of risk RESPA was designed to address. But it is also true that HUD has a number of safeguards in place that protect against that risk. For instance, the requirement to have conflicts of interest policies in place, the 3 referrals that you're required to do, and there are other parts both in the regulation that guards HUD counseling and in the HUD counseling handbook. And if you read this application on page 8, we cite some of the provisions of the HUD handbook, HUD and us, that we think basically mitigate any risks that RESPA might be trying to address. On section 5, talks about exactly what we were just talking about, where is the risk and why RESPA was implicated. I'll note here on page 10 that there's a secondary risk that we should talk about at the end. But it says here in the last full paragraph, counseling agencies have expressed concerns that the activities they conduct in the course of pre-purchase counseling may inadvertently trigger Regulation Z, which is the regulation that covers loan officers, 12 CFR 102.36. HUD, however, is not aware of, is not applying for any sort of relief under the loan originator rule. We have not heard this. This concern came up relatively late. And there is, in the commentary to this rule, something that exempts HUD-approved counseling from the loan originator rule. Unfortunately, in the comment, there is a comment that says HUD-approved counselors are loan originators if, for example, they receive compensation that is contingent on referrals or engaging in loan origination activity other than assisting a consumer in obtaining or applying consumer credit. So there is some ambiguity. This does not solve all problems, but we are going to closely monitor that, and we will modify this if we need to down the road. All right, so the juxt of the letters on page 11, where it says HUD permits lender payments to participating counseling agencies for providing counseling service to consumers. HUD is seeking a null stating that the Bureau will not make supervisory findings or bring a supervisory or enforcement action under RESPA Section 8, cites the law, against a participating counseling agency for including and adhering to a provision in the MOU between the participating counseling agency and the mortgage lender reflecting the terms of the housing counseling funding agreement and the conditions of the lender's payment on that referral. So basically that is the punchline, is that this basically in one fell swoop says the Bureau will not seek any action against any of the 1,700 housing counseling agencies, HUD-approved housing counseling agencies. You'll read another document is there's a template for lenders to fill out. So the way this works is this application basically makes the argument of why counseling is not a RESPA risk and why the Bureau will not seek enforcement actions. But technically, for lenders to get the protection, they would have to file on this add-on letter, and that's the HUD null template. That's the second to last document on the press release, and that document's very short, and this one is addressed to Sarah Jurek, but of course the actual one will be addressed to any lender who applies, and we've been talking to a number of lenders. And it basically, because it's not really counseling agencies most at risk, it's lenders, or at least so they think. The Bureau intends to grant applications from mortgage lenders for a no action letter based on this no action letter template. It refers to the main policy, and as long as the agreement, the MOU between the applicant and the counseling agency has certain provisions in it, which includes things that are in the handbook already. For instance, you must choose between 3 different lenders. The funding is derived from this agreement is based on services rendered, not the amount, terms, conditions of the loan. No endorsement or sponsorship or preferential treatment will be conveyed to the applicant for entering into this agreement. These are all parts of the existing HUD rules, so we thought these were particularly important for the lender agreement to cite. The payment to the counseling agency pursuant to the MOU will not exceed a level that's commensurate, and it will be reasonable and customary for the area. Also, it'll contain a certification from a counseling agency that the counseling agency is a participating counseling agency with HUD, and the counseling agency will notify the applicant, that is in this case the lender, of a status change if it became inactive, terminated, or withdrawn, and the lender will provide a copy of the MOU to the Bureau if requested. And once we receive this very short letter that contains that sort of certification, we would send a letter back to the lender saying, unless or terminated by the Bureau, as described below, the Bureau will not make supervisory findings or bring supervisory or enforcement actions against the mortgage lender under its authority to prevent unfair, deceptive, abusive acts, that's the UDAP, or Section 8 of the Real Estate Settlement Procedures Act, RESPA. So, and that's basically that. So we are talking to lenders now. We have a number of large lenders, non-bank and bank, who are interested in sort of doing this add-on letter. We think that once one or two lenders do this, that most of other lenders who are nervous will receive some comfort just from that. But it is important that we get at least a couple lenders in the door. And perhaps I will pause there and see if Bruce or anyone else wants me to be redirected in some direction.
Well, so just one quick question is sort of, when does this become in effect? So as soon as a lender, well, so why don't you tell us when it would become in effect?
So it's effective for HUD counseling agencies now. In theory, though this would probably never happen, we could have found a counseling agency in violation of RESPA. So the granting of the letter on September 10th basically says we will not ever do that. For a lender to also participate, it'll become effective from the second they submit a form and we turn that around. Since we are not expecting a lender to complete a full application, but basically a statement of intent that will agree to those provisions that I noted, we can turn it around very quickly. So within a couple of days, we will then grant the letter to the lender, and then that lender will have something for its file that says we will not do supervision or enforcement against them for RESPA or UDAP for this particular case.
So we would love to know when lenders have been approved, and we can
of course
let organizations know. So that would be great.
Yeah.
So Melody, do we have questions in the queue?
A few. Could you remind the audience where the link is?
Yes. So you can find the link to the policy at consumerfinance.gov, About Us, the newsroom, Bureau issues policies to facilitate compliance and promote innovation. The press release is both on the no action letter policy itself, and in there in the links at the bottom, you will find the HUD null or no action letter template right there. We will also publish this on our innovation website, but we have not yet. That's consumerfinance.gov/About Us Innovation, but it is not up there yet. So you have to go to the press release. It was issued on September 10th. I'm looking at it right now. I can send the link around.
Thank you.
Bruce
can a template MOU be created that covers all of the issues so that folks don't have to reinvent the wheel, as Dylan said, their words, not mine, and maintain compliance?
So there is sort of a template in the HUD handbook that we looked at heavily as we were working with HUD to do this application. So
I think if you look at the HUD application, it says what needs to be in our housing work plan. And this is what you should already have in there already. What wouldn't hurt to check, but it should be there. But it's the disclosures. It's that you'll commit to telling three lenders, giving at least three lenders information on telling clients that there's at least three loan products that they could look at. I mean, it's a lot of things that are around the mechanics of our work, because it's what already existed in the handbook, and
these are all listed. I was going to say these are all listed on page 7 and 8 of the application, just checked up, marked as bullets. Go ahead, Bruce. Sorry.
Yeah, and this was the kind of the roadmap that we had when HUD was regulating RESPA. When it traveled over to CFPB, they didn't adopt that. And so this kind of gets us back into that, and so it's tremendously helpful. Yeah.
Thank you. Next question. Can you further explain the comments on a HUD agency acting as a lender or loan officer? Because now many lenders are asking agencies for assistance in obtaining CRA qualification, CRA qualified loan applicants, excuse me.
So I think there's a difference between what a counselor does and what a lender does, and it just makes this might be an area where we need further clarification. But when you read the comment that's on 1026.36, it talks about third-party advisors, and it particularly exempts HUD-approved housing counselors assisting consumers with understanding the credit origination process and various credit terms, or collecting and organizing documents to support a credit application. And so it sort of mentions your activities. There's a comment at the bottom of that comment that's less helpful, but we think the core of it is that HUD counselors do act differently, have different incentives than a loan officer. But like I said, this is an area where we'll have to pay close attention.
Thank you. Are there any examples of MOUs or standardized language for MOUs between counseling agency and lenders to ensure that all requirements are met?
I think that goes back to the HUD handbook in page 7 and 8 of the MOU, the HUD application, which lists the provisions that we think are particularly helpful, all of which come from the handbook and the rule.
Will the fee paid have to be shown as a line item in the closing disclosure? And second question to that is, are there any limitations as to the fees earned by the agency?
So the only limitation is that the fees are commensurate. So these are reasonable fees. So you could make an argument based on, what is a customary fee, what is a willing, provider of the service and a willing user of the service willing to pay. As to the second part about the closing disclosure, I'll just cite the reg, which is 102.38F, which requires disclosure of all loan costs associated with the transaction. So, this null does not affect, that's a different part of the law. It's TILA. This no action letter does not address that. So whatever you're doing before, you could continue to do. So we did not address the Truth in Lending Act, the disclosure part of the law.
Thank you. What about counseling agencies that may be using counseling staff for originating or packaging versus obtaining and applying loans internally or externally?
So what's the question again?
What about counseling agencies that may be using counseling staff for originating or packaging versus obtaining or applying loans internally or externally? This was asked by one of the attendees, and if they could, they can provide more context to the question.
Right. I don't know if I can provide much more clarification without sort of a specific one-off conversation about the facts and circumstance of what you're doing. But I think it goes back to that line between what a loan officer does and what a counselor does. There is still some line there.
Does that at all relate? There are some housing counseling agencies that do origination, sort of nonprofit originators. Is that where that question comes from?
And in which case, that's a separate part of the HUD guidance. I think you have to have separations between those two.
Right.
Final question, and I think we should probably move forward. We're probably going to get a lot of questions throughout this entire RESPA presentation, but final question for you, Mark, is today many counselors do not pay for many consumers do not pay for counseling. Will the counseling agencies need to establish a standard fee schedule?
We are not requiring that. And HUD allows you to have a fee schedule, I believe. So, we are not interfering with the the rules of HUD and how they regulate and govern counselor agencies. So this does not address whether you collect a fee from the client or not.
Thank you. So, Mark, stick around in case more questions pop up that are yours. Yep. Good. Thank you. Gene, do we have you for a few seconds at least?
Yes, I apologize. I'm in a taxi, but you do have me for a few seconds.
Well, give your perspective here, given. Yeah, go ahead.
Yeah. Well, I was invited to participate, basically to to sort of talk about housing counseling within this context, and also to talk about how much we appreciated the efforts of CFPB and HUD to move this forward. And so I was honored to represent the community at the event, had an opportunity to engage a bit with Director Craninger and Mr. Watkins and a bunch of folks from the CFPB team. Actually, it's interesting. This was like CFPB week for me. I was on their board for a few years, But once you've served with them, I have learned that they continue to reach out and get you to do stuff. So did that meeting in Atlanta, and then the next day, yesterday, I was over at a Structured Finance Association on a very different topic, but it's still potentially relevant to the community long term, and that was the transition between, LIBOR to a new index that's going to affect a whole bunch of consumer loans. So that's I'll save for another discussion. But again, I was honored to participate. And I think this is, as Bruce has pointed out, we've spent a lot of time on this issue and driven heavily by lender partners who had some serious concerns related to their exposure. And so to be able to move this forward, particularly, over actually, I think you guys, Mark, took this up really at the beginning of this year. And
yes.
to move it this far, this fast, I give credit to certainly your colleagues, Mark, but I also give credit to you because it's having, a catalyst, someone who understands this industry and can help communicate, what this means to, helping support the availability of counseling to consumers. I think it was very, very, we deeply appreciate your work on this.
It was a team effort.
Yeah, that is so true. So, unfortunately, I have a dental appointment. So,
thank you for that.
And unfortunately, that's on my calendar. So, I'll defer to, I think Lot's going to have a conference, right?
Yeah, that's right. So let's pivot over to Lot Diaz from Unidos US. So Lot, you were going to talk some about how you thought this might work with organizations and operationalize this.
Yeah, thanks, Bruce. Hello, everyone. I hope everyone's well. Just before I reiterate, I will start by saying that for me, this has been a long time in coming. We've been at it even before the crisis, because there was always this confusion when you approached a lender relative to to supporting their customer base or a customer who became individual who became a customer on compensating for the prep and the education. And before the crisis, and it exists after the crisis until now, the lenders would many times have to say, well, our lawyers think this might be a RESPA conflict and it's just not worth the risk. So they went through other convoluted ways to kind of find a way to get that fee paid. And for marketing agreements, there's just a whole myriad of ways that legal teams within banks would go around, would find to kind of give a compensation to a individual who closed with that bank. So it was like, I was telling my colleague here, it was like, I feel like a 20-year journey has ended to some degree. But the actual real question is, what does it mean? And how will it impact? Unidos US has a housing counseling network, and so how will it impact them and us? And I think a couple points that were raised earlier are worth reiterating regarding the application that Mark was talking about that HUD made to CFPB. One is, HUD's rules around fee-for-service are going to be the controlling rules relative to the funding agreements and that kind of thing. So in other words, they're known rules to us, to those who have been working on that. And I'm not sure if you all were aware, but HUD issued guidance on model funding agreements and fee structures. I have a copy of it. I don't know, Bruce, if you have a copy of it. Happy to share it, and you can send it out.
Sure.
So the good news here is that HUD's rules apply, and there is models and agreements and stuff who conform to that. The second issue I will reiterate on, it's raised again, is kind of agencies with charge reasonable and customary fees. It's a difficult question to get to because it depends on what kind of service you're providing. Are you providing a loan package with the family that goes to a particular lender? Are you just doing home buyer education? Are you offering other services beyond that? All those have to be factored in terms of how you would structure a particular arrangement for a lender. So, but the one thing I will say, whatever you end up on that fee structure, it should be the same for every lender. I mean, the one thing I got in talking to lawyers and talking to CFPB in some earlier conversations was, one of the key things is that if they see you charging different prices for different lenders for the relatively the same thing, that looks really fishy. So that's just one point on fees. And then the second to last thing on the relative to HUD application is that the work plan disclosure statements, and more importantly, how you deal with fee for service in your work plan, are going to become much more critical. And I will say it's going to be something that HUD is going to be looking into much more closely than they have to date. And I can just talk from the experience I've had within our network. The disclosures are handled pretty well. I don't think that's a problem. The fee-for-service area, if they charge them, which many of our agencies do not, neither to clients nor to lenders, that whole section is going to have to be reworked, and to make sure that it conforms with what HUD sets out as a standard for the work plan. So I think there's going to be some special attention to everybody is going to have to put special attention to their work plan, to make sure that the key elements, well, for sure, if you're going to do fee for service, but even, just generally, I think that whole compliance section for HUD is evolving, particularly now that certification testing's coming in. There's going to be a fair amount of oversight, and we're noticing it with the audits being conducted through the groups in our network. And I think people have to be real mindful of it. But at the end of the day, what's the practical implication of it? And to me, it's not clear yet. I mean, I've been trying to do lender partnerships since I almost started in the business, and they all come together in different ways. But some things I think are kind of work against us in this thing. Is, in other words, work against us meaning not as excited about doing fee-for-service fees. Is that just the revenue that lenders, particularly depository lenders, earn off loans to LMI communities has been going down for some time, and so the incentive to add potential cost to it is probably, that's kind of a drag on it. Similar dynamic, but much less dramatic, is true for the non-banks as well. So the question, it's not clear to me how well this will be received once we make a pitch, and we will be making pitches on this to various partners. So that's not clear, but what it is clear, though, is that it creates an avenue that the banks' legal departments can't quash, which is a really big hurdle that we've confronted in the past. And then lastly, I guess just to kind of our current thinking on this, on how we're going to be playing in the near term, we are going to be approaching some lenders for fee-for-service partnerships with our network. So that is definitely something we're going to be doing. But I think what we also have to do, what we're also focused on, is just developing some base standards and operating procedures around these fee-for-service relationships, which we've been doing pieces of this for a while, but I think it's going to have to be done as a package, so there's less variance in how people approach it. I think the service options and the pricing of those options, we have to work on those and test what the market will bear on those, right? So I don't know exactly. I mean, there's lots of, people have been throwing numbers on what that should be since as long as I've been in this industry. but what people will pay is not entirely clear. We figure at minimum, you know, if people are spending $800 to help a family get through the first stages of pre-purchase at minimum, honest cost. But whether the lenders would pay that full freight is a whole different area. So anyway, so there's a lot of experimentation that's going to have to go on there. And so we're going to be working through some of those issues. And then what we're going to sell, and I imagine other networks would do something similar, is that, you know, as Unidos West Network, it has an aggregate capacity, i.e. number of counselors, number of areas it's working, and hopefully set up a more standardized way for lender partners to enter those relationships, which makes it a little easier on them. I think it makes it a little easier on our local agencies, simply because the kind of the pathways to get from here to there are more clear. They're simpler because they're more clear. And so those, I think those are kind of the three general things that we're going to be doing. One thing I will say, and this is my last point really, I promise, is that what I do know about agency, and more importantly, the boards of agencies, many have discouraged fee-for-service partnerships with lenders because, could be a variety of reasons, but one of them is because they weren't sure it was allowed, right? What I would say is this document, this policy, CFPB, the no action letter, really is a refutation that, of course, it's allowed because you're doing a ton of work with the family if you're doing it well, and there's no reason, and a bank is benefiting from that work at minimum because they have a borrower who's going to be a better long-term risk. But on the front end, they'll come in and they can close a loan in within a 45-day period, where normally it would take 60 or 90, right? So there's there's no reason why compensation shouldn't flow because of that. But the regulatory risk that was always present, this no action letter puts a lot of clarity to, and for that I'm forever grateful. And that's all I got right now, Bruce.
Good. Well, excellent. And I think this makes me think about these issues on the funding, on the pricing. So it's important to understand that it's a flat fee for services delivered. I mean, it could be a tiered fee, but it's a flat fee, so that it's not that it would be tied to the value of the loan or something like that, the way a mortgage lender might do. This is completely, it's paying for service. We should always define it and think of it that way. We should price it that way. And it may be that there might be several different tiers that where there are different service levels you're providing and getting paid for. But one of the big challenges we've got is that generally we're badly underpaid in the marketplace, and so we'll need to figure out how to both clearly define what the value is and make sure that we're getting up on that. And Matt Reby in a minute has got some deep thoughts about this. And then we also need to figure out how to establish a price that's fair to our work and does represent the work we're doing. So this is, as Lot was saying, will be something we're going to have to test out. Were there any questions, Melody?
There are, but given time, I think we should just let attendees know that we usually schedule this until 2 p.m., but we're going to go a little bit over. If you can just bear with us and stay on the line. I think we should go to Matt, and then we'll have the rest of the questions. Okay,
great. Sounds good. Okay. So, Matt? I just want to cue you up. Good.
Hi. Thanks for having me, Bruce. So I'll be quick, and I want to thank everybody. I'll note at the outset, I think it's been sort of inferred, but this is a really big deal that this no action letter framework has come out. It's taken a sort of personal courage from the Bureau to take this step, and it really is in no small part thanks to the concerted efforts of folks have already spoken on this call. We've done work on it at NFCC, and lenders have emphasized the importance of this issue as well. So this, I don't want to lose sight of the fact of just how significant a development this is, and we're really excited about the implications. I want to pick up exactly where Lot made some references, and Bruce, what you were talking about establishing the value of housing counseling. This is something that we at NFCC have done a lot of work on, especially around our Envisioning Homeownership initiative. And what we're thinking about is really trying to reframe the way housing counseling, pre-purchase housing counseling, is delivered. And I think this new development, this new framework that's developing with allowing lender pay will really help us go a long way towards doing this. What we want to be doing is working with people, and this has been a topic of conversation for a long time, working with people before they apply for a mortgage to help prepare them for a mortgage application and introduce them into the marketplace. If we're able to make that transition, that really just categorically changes the value of housing counseling. So one connection I want to make is to a point that Lot raised, which is that right now these sort of affordable loans or smaller balance loans are not the most profitable, in some cases unprofitable for lenders, and that's really a function of the high cost of mortgage origination today, and the relatively lower margins on a smaller balance loan. So if you're thinking, and what we've been thinking about ways to sort of encourage lenders to participate, it is getting back to this notion of value and the value of housing counseling. And with the high cost of mortgage originations, really a lot of that is driven by many people within a mortgage originator who have to work on and help sort of curate a loan as it goes through. And when you think about the loan processor, underwriter, the time and expense of gathering documents and everything like that, for many lenders, it costs between $9,000 and $15,000 to originate a new mortgage loan today. So it's quite cost intensive. If through pre-purchase counseling, we are able to prepare borrowers for the mortgage application process, make sure that they're creditworthy, that they've got enough payment for a down payment, they've got enough savings for a down payment, they may have identified down payment assistance, they're substantially likely to complete underwriting and need less handholding, perhaps even have their documents prepared before they go to a lender, that saves lenders a tremendous amount in processing costs, which can be the basis of evaluation of counseling and the basis for them paying a fee to us to provide the counseling. And it may even be that the total value sort of derived by the lenders by this sort of more efficient process exceeds substantially the fee that they pay to the counseling agency. So not only are they able to support the expansion of pre-purchase counseling, but these loans start to look more profitable for them as well, which increases their incentives to want to do this and to work with us on these issues. So we're, as I referenced, we're doing a lot of work to think about ways to quantify what the value is. Part of it can be through sort of cost savings. Another big issue that you hear from lenders is sort of standardization and sort of having consistency. And so we're thinking about sort of different ways to categorize what the value could be depending on sort of if different milestones or different chunks are met, and ways that can be scalable across the housing counseling sector. So again, this development from CFPB and HUD really, I think, does a lot to advance the state of these conversations. There are some sort of questions, the terms that have come up on this call, sort of the central term for establishing the value is if the payment level is commensurate with the services provided, and if it's sort of reasonable and customary for the area. As I was describing, we're thinking about ways to transform what pre-purchase counseling is, which poses some questions about, what's customary, or on on what basis do you provide the evaluation for sort of an innovative and expanded service? But I think this valuation framework helps to sort of substantiate what that might be. So that's how we're thinking about it. And again, just appreciate all the work that everybody's done to get us this far. Whenever you have a big development like this, that means there's just sort of more work to do, but certainly we're heading in the right direction here.
Excellent. I think it's going to be important for us to, as a community, to think really about what the product is that we provide to the lender as part of this process, and to the extent that we can, as Matt said, increase the value of this, then we'll be able to be more self-sufficient and be able to help more people. So as Melody said, we're going to go over a few minutes. We're not going to go over more than 10 minutes. Do you have any questions that are burning on the list, Melody?
I do. This is just a general question. If someone can provide a link for HUD pricing and HUD customary fees, someone asked about that. This is a really, we'll start with the smaller questions first. How are lenders monitored that HB counseling is completed by a HUD-approved agency? We see that lenders are using non-HUD-approved agencies for counseling.
Well, to be clear, this no action letter only applies to HUD-approved counseling agencies, and the letter itself cites the dynamic list that's on HUD's website, and any arrangement that a lender might have with a non-HUD agency, all the RESPA rules would theoretically apply.
Great. Has it been addressed with HUD to be able to charge clients that are having financial challenges to get ready for home purchase? Many of these home buyers start off in crisis. When they come to us, they're required to get involved with credit repair with creditors. Is there a comment on when you can charge a client that may still be in crisis while we negotiate for home buyers?
That's not me.
Let me say the question again.
I'll ask the whole group, and I'll go slower. Has it been addressed with HUD to be able to charge clients that are having financial challenges to get ready for home purchase? Many of these home buyers start off in crisis when they come to us that require us to get involved with credit repair with creditors. Is there any comments on when you can charge a client that may still be in crisis while we negotiate for home buyers?
This is Lon. I'll take a stab at that. I mean, I think the way HUD approaches fees generally is that the agency has to establish a way you're going to assess their inability to afford those fees, right? And so it could be, we've had agencies that do it if they're below a certain AMI. Some people will look at their reserves and monthly net and say, they'll do it that way and a little bit more intensive. So it's not a HUD standard. It's just a process in which they ask you. In fact, in the work plan, if you do charge fees, one of the factors they want to address is how do you know when fees aren't affordable? And in the case of mortgage default, homelessness, that you can't charge any fees anyway for HUD. So it's really a process more than anything else in terms of establishing when you should waive fees.
Okay, thanks. And for this one, I'll try my best to get the gist of it. It's half of it's cut off by our program. This comment is from an attendee. Truth is that banks really only want to pay for mortgage-ready clients, a client that is already perfect when they come in. And this is the sort of origination through protection of client, meaning that clients approach agencies with huge credit problems, but they, the client, often do not have the ability to pay for assistance. What is the position of the CFPB? This might be for you, Mark, if you're still on. What's the position of the CFPB of lenders or banks paying agencies for straight credit report assistance for the bank's clients who are LMI?
So I'm not sure. So in this case, I mean, it's sort of outside of the scope of what the NOL talks about. Are you saying a bank hires a counseling agency to help a client with credit repair? That seems like, you know, you're purchasing a separate, different service, and it's not contingent upon a referral. So they refer. I mean, depending on how it works, the relationship, the bank may be referring the client to the counseling agency, right? So.
Well, but let's talk about the other part of that. So that, let's say the bank refers people to counseling, so that the counseling agency didn't originate that wasn't the first contact. The lender is, and then they send them back. They send them to the counseling agency. So it's the lender referring somebody in. Does this apply to those cases, or does it limit in any way?
So it doesn't limit it.
Mortgage.
Yeah, I think you have to point to the HUD rules on this. I mean, I could see why a lender would not want the 3 referrals if they gave you the client in the first place, the customer. So and once again, there's no steering risk there because the customer came from the bank in this case. So, but I like I said, I can't provide guidance on where our rules apply and don't apply. It's sort of outside the scope of the NOL. It'd be, you know, if HUD rule, I generally point to HUD rules, and if that's allowed.
Good. Okay, so we're good here. Well, this is very helpful. It's really probably the start of this conversation. There'll be plenty more that we'll want to do, but I think this has been but it's valuable, and I think, as everybody's recognized, this is a major step forward for us. We have some work to do to figure out pricing, and we're very eager to see which lenders step up. And certainly in the field, feel free to encourage your participating lenders to look at this and submit to be qualified underneath the lender side of the NOL. The NOL is no action letter. So we'll send out the links, the information that Lot's going to provide around the HUD guidance on pricing, and we will also send out, again, the CFPB, the links to the CFPB, the various decisions that inform all this.
And also, for those on the call, just know that this webinar is being recorded, and the full recording will be on our website sometime today or early next week, so you can come back and cite all the information from our lovely speakers. Good.
So with that quick note, let's flip over to, we're still continuing to do the pictures worth 1,000 words, and you know, please send these in to Ellie. These have been really valuable, and we love getting them, and it's a great part of our program. If you aren't a member already of NHRC, now's the time to join. We need your support. You can still get the discount on the credit reports. It seems to be quite successful. We're very happy to hear that. But really what you're doing is you're funding the advocacy work we do, and allows us to do these programs and work in Congress and able to do the events outside. It's all fits in and very helpful that groups become members. Our next call is going to be on September 26th, so 2 weeks from today. Our plan currently is on, that'll be on student loans, and especially on the public service loan forgiveness program. Probably you've seen in the news that the performance is miserable. It's a 99% rejection rate right now. So really the question is, what should you be telling your clients, and what should you be telling your staff about how they might be able to get to make this actually work for them? We'll have Natalia Abrams from Student Debt Crisis. She and her team put together the trainings we did a couple of years ago. You know, it's high quality work. She's very much on the cutting edge of this work, so she'll have the latest information for us. And we're also in a bit of a conversation about doing something around disparate impact. I'm not sure when, but we'll certainly let you know. As you know, the disparate impact rules around fair housing and are under attack right now, and this is a pretty critical issue for us, and there's a coalition of groups that are planning on doing something. So keep an eye out on the listserv about doing something for the housing counseling community on that. And with that note, thanks everybody for sticking with us. Great call. Thanks. Bye.